We're now beginning the discussion of non-current liabilities. And the distinction between non-current and current is important. It isn't just the number of months, one being under a year for our purposes and the other being longer. So the term difference, that's not the most essential thing that you understand here. The most essential thing is the way in which these two liabilities are initially recorded. So we are going to be splitting this module according to learning objectives, and the first three have to do with the recognition, the initial journal entry that puts these non-current liabilities on our books. After that, then we're going to start talking about what we do once we have them on our books. So the first part is really doing the initial journal entry. Now you've had a little bit of exposure to this because we talked about that and non-interest bearing notes that were current, and we recorded discount. In this chapter, you're going to learn about discounts and premiums, and you're also going to learn how to do the calculations using time value of money concepts. So if you have difficulty with time value of money concepts, you should review those. There's some assistance within the book. You can go back to Intermediate 1 in a previous chapter in there on the time value of money. You can also review some of the pages that I inserted in the previous module about time value of money. And I don't care whether we do the calculations with a calculator or whether we use the tables. Your calculator is going to be more precise than the tables, and that doesn't mean one is right and one is wrong. It means that on the exams I will tend to use table values, and I use table values when I work through problems, and your numbers may be a little bit different, but it's not going to be enough to be a material difference, and it's not going to affect your performance in any way. So our learning objectives then, the first three we'll talk about in this voiceover, is understanding the difference between the initial recording, this is the recognition of current versus non-current liabilities, and we're going to make a distinction, and we're going to say that they are financial instruments. Because in our previous module we had current and non-current accrued liabilities, for example, and that's not what we're talking about here. We're talking about things like notes payable. We're talking about bonds. So this is a distinction that you need to understand. It involves the flow of cash. So cash coming in, cash going out, and that sort of thing. And then under 2, understand the concepts of premium discount as applied. And what conditions do we have when we have a premium or discount? And then how does it all show up in our financial statements? And all of this has to do with the stated rate of interest and the market rate of interest. So we need to talk about that a bit too. And this is our learning objective 3. And then you see, if you go on to learning objective 4, we're going to talk about what happens after they get on the books. So this again is all about recognition, how you come up with the numbers, and how you do your journal entries initially. The rules in general is that if you have a cash flow expected within the next year, that would be a current liability. Then either an asset or a liability, whatever it is recorded at the cash flow amount, and that is also called maturity value. So it's the amount that's going to flow out when it's repaid. So if a corporation were to sign a note for 1 year, the corporation pays back the amount owed with interest at the end of the year. And the note, we also call this face value. We use that terminology. is 10 million, they get 10 million in, and this is the way it's recorded, and this is, I call this the abridged, the shortened version or whatever of a novel. You've heard of Cliff Notes. This is the sort of thing you got when you were in 201. This class, we expand it. We say a bunch of other things can happen, and if these happen, then how do you record it? So if all is simple in the simple world, in a note from the bank a year under, we're going to record it as a debit to cash and a credit to note payable, so we have only two accounts involved there. And then basically this journal entry will get reversed at the end after that year. And it would be the exact same journal entry, only in the reverse. The note payable will be debit and the cash will be credited. So this should be quite simple for you. But then here's another thing. If you do not have that cash flow to be the repayment in this case, within the next year, that would be, if it's within the next year, it's current, so it's non-current. Then the asset or liability has to be initially recorded, or we say recognized, at the present value of cash flows amount. So here a corporation signs a note with the bank for 3 years. The corporation pays back the amount owed with interest at the end of the year. That would be the 3 years. The amount of the note is 10 million. Well, since present values are required, the accountant has to determine if the interest rate on the note is equal to market rates. And if that is the case, we really don't have to do anything. It's simple. It's recorded exactly the same way as on the previous slide where we had a current liability. So this is a non-current liability. You get to record it as if it's a current liability only if the market rate and the stated rate are equal, and I will define those things. So if the interest rate on the note, which is the stated rate, is not equal to the market rate, which is the general price or the general interest rate that this corporation would face, then we have to do other things. We can't just record it in this simple way. So to summarize this, if the stated rate and the market rate are equal, then a non-current liability gets recorded just the same way as if it was a current liability. And to record this, then we would say we would record it at its maturity value, which is also, we can prove this, is also the present value. The only time the present value and the market value end up being equal is when the stated and market rates are equal. Of course, if this thing is for more than a year, it's out there, then we need to classify it as a non-current liability, and it shows up in a different section or a different part of the financial statement, the balance sheet. Let's talk about market rate then. What is the market rate? The market rate is the rate that a business is going to be facing. And if it is a bond situation, and we would say bonds are non-current liabilities, just like long-term notes payable. If it's a bond, then we say that it has to do with the bond rating. So all corporations who have the same bond rating would have the same general interest rates, and that would be the market rate. That would be the rate that all investors who are investing in corporations that they assume have the same level of riskiness, that's the interest rate they would expect to receive. And what happens then is there is the fact that you're loaning money out, you expect to assume you're going to get some return. That is a risk-free rate, and then you add on to it an amount for the riskiness of this particular corporation. If it's bonds, it's the bond rating that has an associated interest rate. If it is the bank is going to assess the financial condition of the corporation or the business and is going to determine what that rate should be. And the reason why we use the term market rate is, again, the last statement at the bottom of this slide is because with bonds, there is a formal marketplace where buyers and sellers trade, and they set the price of the bond, and it has to do with interest rates and changes in interest rates. And I'm sure some of you have had this in your finance classes. So the bond terminology we all need to learn. The market rate is that interest rate that expected to be paid by the corporation or the business. And if it's a corporation and it's bonds, they're called the issuer of the bonds. The market rate is going to change with the economy. It's also going to change, as we saw on the previous slide, with the riskiness of the corporation. The stated interest rate. The reason why we use this word stated is because it is written down somewhere within the legal documents. So if it's a bond, it's going to be on the bond certificate. If it's a note, it's going to show up somewhere within that note. And I hope you were able to look at what a note looks like when you took your intermediate one class, because it either is going to say how much interest is going to be paid or it's going to give the interest rate. Either way, you know what the interest is, and this is the stated is the amount of cash that flows periodically, usually in payments. Now, the interest can be paid, say, quarterly, it can be paid monthly, it can be paid annually, it can be reserved and paid all at once at the end. And this becomes important to us because when we do present value calculations, we're talking about periods of time. So how do you look at the periods of time? How many periods of time are there? And one way to look at that is to look at how frequently the interest is being paid. So you might have something that looks like it has a 3-year term. It's going to be paid off in 3 years, but it will say interest is paid semi-annually. Well, instead of having a period of period number equal to 3, since the interest is being paid twice a year, you're going to say the period is actually 6. So that also becomes important. But stated means it's written down. I think it's fairly easy for us to understand that. And because it's on the contract, it's what they have to pay. It's determinate. It's definite how much interest is going to be paid. The market rate, though, is going to change. And it changes as the economy changes, as the corporation changes. And recently, we've had market rates that have gone really, really, really low. And that might not be the same as the interest rate that has been stated on a document, because a document might have been signed 4 years ago, and today's rate may be less. So there is a disparity between market rates and stated interest rates, and this happens quite frequently. One of the major reasons that it happens is you have legal documents created at one point in time, and then something happens in the marketplace, and between the time that the bonds are, say, issued and the time that it had been printed, the interest rates change. So the stated that's printed on the bond is going to be there and it's not changed, but the market has changed. So when it initially gets issued and the company does their journal entry, there's going to be a difference between what's on the bond certificate and what the market is. Now, if you are an investor and you're interested in buying this bond, you want to make sure it pays a market rate, because the market rate relates back to the level of risk. And if you could invest in two companies, as a future slide will show us, if you could invest in two companies that are equally risky, why would you invest in one that's paying you a lower return than the other? So if the return is not adequate for the investor, meaning the stated rate on it is not up to the level of market, then it becomes traded at a discount. Now, conversely, if that bond pays more than the market, everyone's going to want it, right? And so that would be a premium. So those are important concepts for us to understand when we would have a discount and when we would have a premium. And I think the easiest way for me to remember it is to think about an investor. I've been talking about bonds, but much of this also applies to notes. In fact, we're going to be doing our journal entry work exactly the same, except instead of saying bonds, when we say the liability, we'll be saying note payable. We'll have discounts, we'll have premiums, we'll have market rates, we'll have stated rates, and all of that will be the same. Instead of having a bond certificate, you have a contract, which is a note itself. But we'll be handling it the same way. So my example, as I was alluding to you before, is if you had $10,000 to invest in Corporation A and get an 8% return on it, you could pay $10,000 into Corporation B and get 10%. Why wouldn't you invest in B, right? So no one would invest in A at 8%. So for you to invest in A at 8%, maybe they're going to let you pay 9,000 instead of 10,000, but in the end get back your 10,000. This is the same sort of concept we had in the previous chapter when we were talking about non-interest bearing notes. We said, who in their right mind would loan money when there's no interest going to be paid? And the answer was in the beginning. In the beginning, we take our interest. We just loan out less money in the very beginning, and then in the end, we expect to be paid back more than we've loaned out. And that's exactly the situation for a discount that you have when you have a bond and the interest rate that's stated on that bond is not adequate. So here's a comparison for you then. If you had that Corporation A and let's say you gave up $9,000 as an investor, and in the end you'll get the 10,000 back, well then you've made 1,000 there, right? And if you get the interest, which is 8% on your money for the 3 years, you get 2,400. So that's $3,400. And then in the other one, let's say it's at the market rate. Your market rate, you get your interest of 3,000. So in the end, you end up with 3,000. So you see what happens here is you play around with the numbers, and the number here is this one here is $1,000 less than it should have been, and you play around with these until these numbers here at the bottom are equal. And when you've equalized the numbers, then you know that is the proper amount of cash that should be going in from the investor to equalize the fact that the interest rates are not equal. So that's the basic concept of it. However, it's a little more complicated than that because you are giving up the 9,000, and the 9,000 has a time value of money feature to it, and we haven't brought any time value of money concepts in here at all. We were just talking about basic cash flows. So the whole thing here is trying to figure out how much less cash or how much more cash will flow in the beginning to compensate for the difference in the interest rate because the stated is not equal to market. That's the whole concept. So if we have a $100,000 bond, now with bonds we refer to that as face value because that's the amount that's going to be paid back at maturity. When we look at notes, we tend to call it maturity value. It's the same thing. It's just that one's a bond and one is a note. This one, market and stated are equal. When market and stated are equal, we have no issues. We get to record the cash coming in and the liability at the face amount. There's no adjustment needed. And as we said previously in the concepts, even though this one is non-current, it gets recorded just as if it had been current. How about that? So when we do the calculation, we need to take the face value times the present value of 1 given the number of interest payment periods and the percentage of the market interest rate. So when you do your present value calculations, I want you to understand that what you will need to do is in your present values, always use the market interest rate. Okay? Always use the market interest rate. So the first part of our formula, and this is the formula which you will get to become very familiar with, this number, this $100,000 here, is the face value or maturity value in the case of a note, the amount that's going to be paid at the end. You're going to present value of 1 back to the beginning, the day you're going to do this journal entry, and that is 5 years in this case, and the market interest rate is 10%. So you need to go to your PV of 1 table, look at the row with the 5 on it, go across, look at the top column for 10%. And when you do that, you come up with this number right here. So you multiply 100,000 times this, and you come up with this number. Well, that is the present value of $100,000, which is the amount which will be repaid at the end of the 5 years, discounted back for 5 years, assuming a 10% return is earned on the initial amount. So if you invested $62,092 and you went out 5 years, you compounded it annually at 10%, you'd come up with $100,000. That's what they're saying. So take the $100,000 back to today, and that is the 62,092. Now the other part about this is that you also have a stated amount of interest. In this case, the stated amount, which is paid annually, every year they pay the interest of 8% on the 100,000. That's $8,000. So now for that, you need to do the present value of an annuity, 5 periods of time, 10%. This is an ordinary annuity. You have annuity dues, you have ordinary. This is ordinary, so be sure you're in that ordinary table. Notice here that these are the same row, the same column, but they are different tables. This one is, again, always market, always market. These columns, the numbers in here, are cash flows. So the present value of the $8,000 in streams for interest, and this is going to be paid for 5 years. If you take a present value calculation of that, you come up with 30,000. And someone's going to say, well, it's 8,000 times 5 is 40,000. Yeah, it would be 40,000, but that isn't getting us to the present value of it. You have to back out the interest on the 40. You have to go back to the beginning. So if we take a present value of equal payments of 8,000 over a 5-year period, and we take a present value of it, we get 30,000. So the cash really on this is 92,418.32. Now this problem has us with $100,000. That's the face value of a bond or the maturity value of a note. And we have a market rate of 10%, and we have a stated rate of 8%, and we have a term of 5 years. Okay? And the question is, what is the amount of cash that should be in the transaction when it's initially recorded so that that investor gets the same as a 10% return on 100,000? And to do that, to equalize it, we do this calculation and we say the amount of cash that the investor is going to lend to this corporation is $92,418.32. Now, how much does the corporation have to pay back? Right, the corporation has to pay back $100,000. So you do a journal entry, and if you recorded cash debit for $92,418.32 and note or bond credited for $100,000, which is what has to be paid back, your journal entry is not in balance, is it? Your debits and credits are not equal. So what we have to do is create either a discount or a premium. Apologize, you can't see the very bottom of the journal entry on here, but the bottom is a credit to bond payable of $100,000. So here we have $100,000, 10% market, 8% stated, 5 years interest. It's very important that we say paid annually, because I said before that means that our periods is going to be 5. If it was semi-annual, our periods of time would be 10. The other thing that changes if you were to do this semi-annually is if it's 10% up here, these are annual interest rates, so that would be 5%, and the 8% would be 4%. So you see things change if you change it from annual to semi-annual. But you have to first look at this problem, and the setup is on the previous slide. You have to look at the two cash flows. What are the two cash flows? One cash flow is the $100,000 that the corporation's going to have to pay back after 5 years. You need to discount it, PV of 1, 5 years, at the 10% rate. And then the other is the interest payments that are going to be made 5 times, and each time is at the end of a year, and therefore it is an ordinary annuity, and it is going to be paid $8,000. So the cash flow is going to be $8,000, and then that has to be discounted again for the same factors. It's 5 years and 10%. The two combined gave us this number right here. The bond payable, the line you can't see, is what they have to pay back. And our journal entry is out of order. To make it in order, you need to create a discount on bonds payable of $75.81.68. Okay, now I want you to think of another concept here that might help you. If the market rate is 10% and the amount it pays is 8%, are investors going to be happy? I don't think so. I think they're going to say, I'm not satisfied because I'm only making 8% and I should be making 10%. So therefore, we know the amount of cash that's going to come in from those investors is not going to be $100,000, because those investors are going to say, I can do better somewhere else. Now, when we do the financial statements and we present this, we show this discount account with the bond every time we do it when we do our financials. So when we first do it, after it's recorded, the day, if we had to do financials, say the next day, we would do it like this, and this is the way it would show up in our balance sheet. It would be bond payable less discount and then it would be 92,418.32. And technically, you can either show it, give the discounted amount in there, or you can say net of discount, but you have to disclose it so that whoever is reading the financials can figure out what the discount is and what the net is. You can't just put 100,000 there. You have to show it in a way that the investor can see that it's been discounted and can get at the numbers. Now, on the previous slide, we had the bond payable as a credit balance, and we had a debit to discount. So this is also helpful when you're trying to figure out, well, do I subtract it to get it? And this net value here is called carrying value. So do I subtract or do I add to get carrying value from the 100,000? What do I do? Well, initially, when you recorded it, you had a credit to bond payable 100,000 and you had a debit to discount for 75,81.68. So therefore, you see one's credit and one's debit. So you should subtract, right? Yeah. So that's the reason why you do that. Now, the next set of learning objectives, we're going to talk about this discount, because as we had in our current liabilities, we have to get rid of it. It has to go away. We have to somehow get that off the books, because what are we going to pay back in the end? 100,000. So I need that 75,81.68 to just go away in 5 years. At the end of the 5 years, I only want to have the 100,000 on my books, and I'm going to pay it off. So we have to have a way to get rid of it. And so we will have to talk about how we're going to do that. And this bond discount account is going to have to be removed. And the way you would really remove it is to see, it's initially as a debit. So you're going to credit it to get rid of it. Now, in the previous chapter, we had the top part of this. We had, for non-interest bearing, we said you have a discount because it doesn't pay interest, and it should pay interest. It's not adequate. No one would loan it without interest, so therefore they're going to take the interest up front, and we're going to call it a discount. And then we said we're going to get rid of that discount by treating it as if it's interest and taking it off. Well, you do the same thing here, except in this case we have two interests. We have the interest part from the bond discount removal, which we call amortization, but you're going to also have interest, which is being paid in cash. So in the previous example, we were paying $8,000 in cash every year. So we would have cash interest expense. You could say there's a cash interest expense, and it's this bit and this bit, and that's 8,000. But you're also going to have an interest expense that's coming from getting rid of that bond discount. So that's going to happen as well. So we're going to talk about that, and we're going to work with this next, and this gets us into our learning objective 4. So I'm going to be stopping right